Qantas Airways reported its biggest ever financial loss on Thursday after writing a hefty $2.6 billion Australian dollars off the value of its fleet due to a company restructure. The $2.6 billion write-down was due to a restatement of the cost of aircraft purchased in the international division. The sizable write-down gave the carrier an unprecedented $2.8 billion Australian dollars net loss for the year ending June the 30th, compared with a restated net profit of $2 million a year earlier. The so-called flying kangaroo has been bruised by high fuel costs, a strong Australian dollar, increasing international competition, and a domestic price war with arch-rival Virgin Australia.
There's no doubt that today's numbers are confronting, but they represent the year that is past, and we have now come through the worst. With our accelerated Qantas transformation programme, we are already emerging as a leaner, more focused and sustainable Qantas Group. Our work is on track, and we see accelerating benefits in the coming year.
Despite the headline losses, shareholders reacted positively to the news that the company's prospects may soon be improving. Shares in the airline hit an 8.7% increase in mid-morning trade on Thursday at $1.41, a 3-month high and the biggest intraday gain in a year. Foreign and individual investors can now take a stake of up to 49% in the international arm. That's a major change from the previous limits on ownership by individual investors of 25% and by foreign-owned airlines of 35%.
The changes arising from the structural review will deliver significant short and long-term benefits. Importantly, there's a clear and significant easing of both international and domestic capacity, which will stabilise the operating environment in which we are in.
Analysts expect rival Virgin to post a $250 to $270 million pre-tax loss when it reports earnings on Friday, with both airlines caught out by excess capacity in international markets and moves by international carriers to increase capacity into Australia.